But Surbhi, you were reading this Morgan Stanley note. Just as we were entering in, you were telling us that they've written an interesting piece on the internet companies. Can you tell us the key takeaways?
Absolutely. So this is going to be, I think, a repeat feature from the house of Morgan Stanley now. They have come out with the India, it's actually an India IT report, but it's more focused on the internet companies. And they've studied the entire lot, Nykaa, PB Fintech, Paytm, etc. Basically the entire universe. They have studied these companies on 3 key parameters: growth, and they've looked at growth trends versus the pre-COVID levels and what their projections are for the next 4 years. They're talking about margins and valuations. They've studied all these companies on 3 parameters. So what came out of it? Number one, Morgan Stanley observes that companies are now trying very hard to strike a balance between growth and profitability. And we've seen that in some of the numbers. We've seen that in the commentary as well. And they're saying PB Fintech, Paytm and Zomato are actually leading this charge. And they are expecting these 3 companies to strike the best balance perhaps between growth and profitability over the next 4 years, right up to FY27. So that's the first observation. Second, they're saying there is a convergence in profitability across companies, irrespective of the stage the company is in or the rate of growth the company may be having. So even if it's a low growth company, the focus on profitability is becoming clearer and clearer. And they are expecting, this is Morgan Stanley saying, that there should be improvement in a better margin, led by better contribution margins for some companies like Zomato, PB Fintech, and also stronger operating leverage. These are 2. I'll talk more about this in a bit, but these are 2 reasons why Morgan Stanley is saying there should be improvement in profitability, better contribution margins, and stronger operating leverage over the next 4 years. The third point that Morgan Stanley observes is that profit upgrade cycles will be the key that will determine whether stocks do well or not, and we've seen that play out. Morgan's estimation is that in this last 6 months, if you look at stocks, we'll just pull up, actually we should pull up the maybe the 1-year chart for a lot of these. In the last 6 months, in this calendar year, for instance, Paytm is up a whopping 60%. Some of the others like PB Fintech is up almost 50%. So it's been a very good calendar year for some of these stocks. So they're saying that this is largely because of flows coming in from domestic institutions, whereas foreign investors have actually been selling down their positions in these stocks. It's the mutual funds which have started accumulating, which is behind the rally, so to speak. So those are some of the key observations that they're making.
Okay, got that. And, we have seen a lot of brokerages also write on this, right? That this trend is sort of picking up of profitability. But does Morgan Stanley see this as something that can really last longer and something that's going to be durable?
No, that's absolutely the million-dollar question, right?
Yeah.
Can you buy these businesses for the long term? Can they maintain this sort of track on profitability? Morgan thinks yes. They're quite convinced on some of the companies. So Morgan is saying there are several factors that are leading to this improvement in profitability. Improving contribution margins, better take rates, for instance, specifically they single out Zomato on this, and then higher revenue coming in from side businesses which are looking more profitable. This is where Paytm has been a beneficiary, and higher renewable business which has helped PB Fintech. Then there is lower ad and promotional spends, lower marketing expenditure, which has helped some companies like Zomato, Nykaa and Paytm. Operating leverage. Remember, I was saying that Morgan feels that operating leverage is going to be very strong for some companies. That will help them stick to this path of profitability, specifically Zomato, MakeMyTrip, Paytm, and PB Fintech. Whereas they're saying that for Nykaa and delivery, they're not expecting too much operating leverage because Nykaa is investing in other businesses like fashion. Delivery has some volume issues, so that's what they point out. And finally, they're saying that a couple of these companies are actually curtailing investments that they had made in side businesses, which are not now really reaping in the profits. Just to quickly end this, Morgan is saying profitability will improve pretty much across the board for the entire internet sector. They're saying delivery and MakeMyTrip will be a strong play on good operating leverage in the coming years, whereas PB Fintech, Paytm and Zomato will be a play on better contribution margins over the coming years. They're expecting Nykaa to be the most profitable company on a EBITDA as a percentage of gross merchandise value, that GMV parameter, if that's what an investor wants to go with. Their top picks, in order of preference, PB Fintech, target price is 810 for the stock that they have. We'll put up PB Fintech for you. 810, Zomato is number 2 on their list, and the third one is Nykaa. And the rough upsides that we're talking about range between 11% to 23-24% across these 3 stocks.
On Friday, PB Fintech held an analyst meet. It was a virtual analyst meet, and it was held for the first time since the company went public, since its listing. So I spoke with one of the analysts to find out what happened. And they said, well, this was an analyst meet purely to showcase the company's products, the technology, how they're using artificial intelligence. It was a no numbers analyst meet. So it's not that they spoke about the numbers or there has been any change in the guidance. They were actually very tight-lipped when it came to the numbers. But some of the interesting things that the company spoke about, which is again, non-numbers, they did say that 80% of their traffic is organic. They are using artificial intelligence a lot to improve their underwriting processes, which will help in bringing down the risk. And also the companies managed to tap into many of the underserved customer segments. And that includes NRIs. Again, so this would be the affluent segment. Again, typically you would assume affluent segment would have a lower risk when it comes to underwriting, housewives, the underprivileged. So IFL is also bullish on PB Fintech. Their target price is $750. So not as high as Morgan Stanley's $810, but they also are bullish on PB Fintech, the owner of Policy Bazaar.
Well, that explains the 5% pop that we're seeing on the stock today, because you have some of these positive views that are coming in.
Yeah, absolutely. And considering just 6-8 months back, right, this was a unanimous, not unanimous, but there were a lot of concerns on the valuation front, which is why all these stocks went corrected a fair bit. Get into a break. Up next, we'll put the spotlight on gold as prices rebound from lows of $1910 per ounce.